Hello everyone, and welcome to another episode of the Daily Gwei Refuel, where I recap the latest news in the Ethereum ecosystem. I'm your host, Anthony Sassano, and today is the 5th of January 2021. Alright everyone, what a really big day yesterday. Crazy last 24 hours, I guess, both in the markets and also this major announcement out of the US banking regulator, the US Treasury OCC. This pretty much was the talk of, I guess, like crypto today. So I'll break down what it is. Basically, the Treasury OCC has put forward new guidance that allows US banks to use public blockchains and dollar stablecoins as a settlement infrastructure in the US financial system. This is probably some of the biggest news in quite a while, at least outside of the crypto ecosystem, because this is obviously the traditional finance system. It is outside of what we're obviously building on crypto, but in the Ethereum space. But what it does is it lets the traditional finance system kind of like legally, or like, without fear of regulators, to participate in this new kind of economic system or systems that we're building, which is huge, right? So, I mean, Jeremy does a really great job of explaining here. For those who don't know who Jeremy Allaire is, he is the co-founder and CEO of Circle, which is the issuer of USDC. So he goes on, and to explain it quite well. He basically says that banks can now treat the public chains like Ethereum as infrastructure similar to how they treat Swift, ACH, and Fedwire, and stablecoins like USDC as an electronic stored value. And he says the significance of this can't be understated. And yeah, I mean, I repeat that as well. This is incredibly big news, incredibly bullish news, particularly for, Ethereum, right? Because that's where all the stablecoins live. Now, do I think that the banks and all this stuff are going to be settling to Ethereum immediately? Maybe not. Maybe they're going to have their own kind of like private implementations. Maybe they're going to do it through something like Comp Chain. This was actually something floated around about Comp Chain, was that they were actually building this as, regulatory compliant, kind of like, it's not super decentralized, but it allows these players to tap into, the crypto ecosystem and then go into Ethereum and things like that. So maybe they'll use something like that. But I think, if they want the best security guarantees, they want the best kind of liquidity, they want to be where the party is, that's on Ethereum, right? I mean, yes, the fees are high, but these are banks we're talking about. They can afford to pay these high fees. They won't even blink about them, sort of thing. And it's not like they're going to be doing, incredibly complex transactions all the time. That if they're just settling to the Ethereum network and settling transactions, they may only have to do that a few times a day or something. Whereas they could have their own kind of private system, or maybe like a permissioned blockchain or something like that, where they run all their other transactions on and then just settle it to the main chain or something like that. But the fact that they've got guidance now on this, and that they're kind of like not going to run afoul of regulators if they start doing this, is massive. And I think USDC stands to benefit greatly from this because it is the biggest regulated stablecoin. Obviously, there's Tether, but the US regulators are not going to just let all these banks use Tether, for example. So USDC is perfectly positioned here, and I think that we're going to see some tremendous growth from USDC this year. The liquidity is going to get going to explode. Basically, the supply of USDC is going to explode. It's going to become the preferred centralized stablecoin. It might even overtake Tether USDT. So we'll have to kind of keep an eye on that and see how that plays out. But yeah, I'm sure you saw this all plastered across Twitter. Like, everyone had their own thread about it. I mean, I woke up to the news and I was like, wow, this is just going to be massive. So I'm really excited to see what comes out of this. And even you can see here, just based on the likes and retweets, I mean, this is huge for a crypto tweet. I don't really see many crypto tweets get this much engagement. So you can see that not just, I guess, like the Ethereum ecosystem, but, the Bitcoin ecosystem and whatever other ecosystem and communities are incredibly excited about this as well. Whenever we get regulatory clarity within cryptocurrency, the markets love it because they're more risk on. There's more certainty. So, markets hate uncertainty, right? So they really hate it when they have to trade around uncertainty and like step on eggshells, try not to break any rules or whatever. Or if there's some regulations coming down the line, they're kind of spooked and then it kind of trades sideways or down. Whereas this kind of gives guidance there and helps people a lot. So yeah, that's really cool. And I also think this is going to open the door to DeFi in general, right? the banks, might say, okay, well, how can we use this new DeFi infrastructure, right? How can we tap into this? This is a massive ecosystem. It's global. It's much more efficient. It's much better for innovation. There's a lot more you can do on here. The banks are definitely going to tap into this. They just needed the regulatory approval to do so. So it's going to start with these kind of like stable coins, and then I think it's going to move into DeFi. It's going to need to become a lot safer. The banks aren't going to be using, your latest DeFi app or whatever. They're going to be using the established players like Compound and Aava and things like that, and maybe even Maker and stuff. But that's probably going to take a little while still to come. I think that in the meantime, stablecoins will be their gateway drug, and then once they've kind of like gotten addicted to that, they're definitely going to try out DeFi. Whether internally as it kind of like in their innovation labs or anything like that. So yeah, it's going to be huge. So. We'll keep an eye on this, see if there's any other news that comes out of this. But yeah, I think it's a great day it was a great kind of last 24 hours for the crypto ecosystem, not just the Ethereum ecosystem, which is really, really cool to see. So Futureswap V2 is now live. This went live a little while ago where they had kind of caps on how much liquidity you could put in as it was like a beta. But yeah, basically their V2 is now live. And what you can do on Futureswap is that it's basically an on-chain perpetual protocol where you can take out 10 times leverage. It's got live pricing, and you can earn FST governance rewards as well. So yeah, if you're into that, if you're a trader, definitely go and try out Futureswap. I've heard really good things about them, from people who tested it when they had their V1 out there. It's also been audited, so you'll be safe, right? It's not just your latest kind of yield farm that everyone's aping into or whatever. You'll definitely feel safe trading on here. But yeah, do kind of keep in mind that this is, a new product still, so there might be, something that could go wrong with it. But yeah, definitely check it out if you're a trader. Really funny tweet from Hazu last night for me, I guess. He basically says in this tweet, the salt of alt-chain founders when people rather pay $100 per transaction on Ethereum than use their ghost chains for free. Now, this is really funny. I mean, obviously with the high gas fees, and I'm actually going to talk about the high gas fees for most of this refuel because I think it's very relevant right now. But basically, it's causing a lot of these other kind of chains and a lot of people to question, like, is activity going to move off Ethereum and is it going to move onto these other chains? And I just don't see that happening, right? For multiple reasons, and I'll run through them quickly. Basically, to move your product from the Ethereum ecosystem where literally everything that matters is happening, right? And to move it onto a new chain where you have to build up the network effects from scratch is really, really, really hard and doesn't make much sense, right? The much easier approach and the much easier path to go down for these teams is to just go on layer 2 Ethereum. You retain Ethereum's network effects, you retain Ethereum security, and you basically give the end user an amazing experience where they don't have to pay these high gas fees, and it's much quicker for them to do their transactions and things like that. So I don't see it happening. I really don't. And not only that, there's also the fact that there's so many chains to choose from, right? So you have like Ethereum at the top by far, nothing even comes close really. And then you don't even have a second place. Like if I ask people, what's second to Ethereum, I'm going to get 10 different answers, right? If I ask 10 different people. So how does a project choose, right? Say Uniswap, for example, was like, okay, let's migrate off Ethereum. Ethereum's too expensive for our users, even though Uniswap's use is just going up, right? As well. But let's say they just, as a thought experiment, they just said, we'll go somewhere. What are they going to choose, right? I don't know. I really don't know. I couldn't even tell you what they would choose. And because there's too much choice out there. And that just fragments things further. The network effects are basically kind of non-existent. So, you're just fragmenting it out and you're leaving, it's what you're doing? You're basically leaving the party that's like, popping basically. Like all your friends are there, everyone's there, you're having the time of your life. And then you're like, oh, you know what? I mean, it's too crowded here. I want to go somewhere quieter. And you leave the party and you go home and there's no one there. That's what it's kind of like, right? So why would you do that? It just doesn't make any sense. So I kind of feel like we're going to scale Ethereum at layer 2. Most projects are going to choose to go onto layer 2 instead of migrating to another chain because it just makes a lot more sense to do that. And I think those projects who do go to other chains are going to lose to the ones that stay on Ethereum and, build out the layer 2 ecosystem on Ethereum rather than trying to, start from scratch. I just don't think that's a winning strategy. And obviously, as Hazu notes here, this makes the other chain founders very salty, right? They don't like the fact that Ethereum is so successful, even though Ethereum has all these issues that they're trying to fix, right? And I think they miss the core point here is that, yes, Ethereum has issues, but I mean, it doesn't matter, right? It doesn't matter. It goes so far beyond that, right? Where the people in the Ethereum ecosystem are going to basically stay and work on what we've got rather than migrate across, right? It just doesn't make any sense. And it goes, beyond just pure, I guess, technical stuff and network effect stuff. It goes into the values that the Ethereum community holds as well. For me, Ethereum basically meets all the values that I hold. This fully decentralized, doesn't sacrifice on decentralization to achieve scale, permissionless, censorship resistant, trying to build out the best decentralized system that we can. Basically, those are the values that I kind of, love. And, I know maybe some of you kind of watching or listening to this will have kind of maybe own coins of other chains and things like that. I think that's fine. You can speculate on whatever you want, but I just wanted to make it clear that I just don't see a world in where Ethereum loses at this point. It's not like Ethereum is looking, the community is looking at these high fees and it's like, oh, okay, that's fine, whatever. Let's just let that play out. It doesn't matter. What they're doing is they're innovating, right? It's not just innovating on layer 2. We've got ETH2 coming as well. The Ethereum community and ecosystem is pushing forward. It is not resting on its laurels. So I think that's what a lot of people miss as well, is that when Ethereum is not giving the opportunity to other chains to kind of quote unquote take over or take market share around from Ethereum. Ethereum is basically cementing itself and increasing its network effects while aiming to fix the issues as well with apps that are live. And I'll get into that. There are actually so many apps live on layer 2 right now. So yeah, I don't see this migration that everyone wants to happening. I see the migration to layer 2 happening, and the other chains, fighting amongst themselves for some minority market share, whatever. Given that we're in a crypto bull market, a lot of these coin prices might go up because the market loves narratives, and the narrative of other blockchains when Ethereum's gas fees are high, is really great. It's kind of like how in 2017, the narrative of Bitcoin Cash being cheaper to use than Bitcoin sucked in a lot of people, and Bitcoin Cash ended up pumping, right? I think we're going to see that play out this cycle because we're going to get a lot of new people in, and these new people are going to come and they're going to experience these high gas fees, and they're like, oh, these other chains are cheaper. Like, why don't we just use these chains? And they're going to, obviously, because they're new, they're not going to know all the intricacies. They're not going to know all these things that I'm talking about, and they're going to buy these coins, and these coins are just going to go up because of that. I don't think that's a signal of success at all. Just because a coin price goes up doesn't really mean anything. I mean, if it did, then XRP, would actually be doing something rather than just being worth what it is. But yeah, I obviously have a lot of strong thoughts here, given that I'm very close to the Ethereum ecosystem. But I think that if you really think about it and really, try and make sense of it, you'll realize that it just makes much more sense for projects on Ethereum to migrate to layer 2 rather than migrating to a new chain and hoping for the best. It's just such a huge risk. And from someone who works at one of the companies that works on Ethereum, it's hard enough to build and grow on Ethereum with its limited user base than it is to go to a new chain, right? I just don't think it's gonna happen. But yeah, we'll see what happens over the next few months. I'm betting on layer 2 Ethereum. All right. Speaking of high gas fees on Ethereum, I tweeted out this picture today of basically the crypto fees site. So if you go here to cryptofees.info, you'll see a kind of a table of different networks and apps running on Ethereum and their fees that they're being paid each day. Now, obviously, the fees are very high over the last 24, 48 hours. And as you can see here, Ethereum is reigning supreme. It generated $20+ million in fees. And Bitcoin is a distant second at $3.5 million in fees. Now, I wrote about this in today's Daily Gwei newsletter, which you can go check out in the description, about my thoughts around why this is fine and why this is really great. Obviously, high gas fees are hurting all of us, but there's a lot of reasons why this is really great, I think. And it's even funnier to see that, even just apps on Ethereum, like Uniswap, are generating more fee, almost as much fees as Bitcoin. And that's actually flipped a couple of times in the past as well. And then you have like obviously Sushi and a bunch of other apps here, and then you scroll down and you see the other networks too, right? They're not generating much fees because their economic activity is just like non-existent basically. And that's what I argue in my piece. So yeah, go read the piece. I won't kind of rehash it here. But the TLDR is basically that, you know, when there's this much demand for Ethereum, you can't really kind of say that Ethereum is dying or unusable or whatever. Ethereum is very usable if you're paying, you know, the price, right? Of course. But it's just yeah, it's just a perfect way, I think, to see network activity too, because it's very hard to game fees, right? Because you'd have to pay the fees and it's just very expensive. So it's a very easy way to measure demand for a network while taking into account that people can Sybil different things. But yeah, they you know, to Sybil this would require someone to pay, you know, even if they wanted to do the whole thing, they'd have to pay $20 million in fees, and that wouldn't go to them, that'd go to miners. Unless, I guess, like the miners kind of did it, but I mean, maybe that could work, but I don't think so. And also, there's this meme here from Cyber Hokey, which I thought was pretty funny. As I said before, you know, these other chains trying to advertise low fees and things like that, and no one really cares because they're having too much fun on Ethereum, right? That's where all the activity is, it's where the party is. So yeah, I thought that was quite a funny meme to kind of encapsulate that as well. Speaking of gas fees again, and I mentioned before how there's already a lot of apps on layer 2 on Ethereum, I put together this kind of incomplete list on Twitter today. So if you want to experience the future of Ethereum, basically what layer 2 is going to be and how it's going to kind of like, I wouldn't say fix everything, but alleviate a lot of the issues, you can go try out Loopring's decentralized exchange, which is both an order book one, and they also have an AMM, so like similar to Uniswap. Diversify has a similar kind of setup with their order book exchange. I'm sure you've all tried out the Matter Labs' ZK Sync on Gitcoin during the grants round, so you've probably already experienced it. Curve Finance also has a ZK Sync stablecoin DEX that you can go try out. Synthetic staking using Optimism is also live on testnet, just for staking, not their actual exchange. So you can go check that out as well. And I have all the links here. I'll of course include this in the YouTube description too. So yeah, it's not like this is like a pipe dream where everyone's saying, you know, yeah, the fees are high, but just wait, Ethereum layer 2 is coming, right? We'll be fine. It's going to fix everything. And then there's just nothing to show for it. There is plenty to show for it. The tech is real. The tech is live on mainnet. You don't have to wait. You can go use this now. The only thing we're waiting for is for the major apps to go there, right? So something like Uniswap is what we're waiting for. And I think Uniswap's going to be the game changer here because Uniswap is the most used app on Ethereum by far, I think. So once they migrate, it's going to be like a snowball effect. And we're also going to be seeing the power of it. And everyone will be able to see just how awesome layer 2 is and how Ethereum is going to scale. And then I think that, you know, over time, it's going to be like probably a multi-year thing. It's not going to happen overnight. But over time, you know, these high gas fees and people complaining about them, you know, and people experiencing them will be a thing of the past. So really looking forward to that. But yeah, if you wanted to check out layer 2 today, you can. Links in the description. Speaking of layer 2 technology, Vitalik posted this blog post today called An Incomplete Guide to Rollups. So I've spoken about rollups a lot lately, the different kind of versions of ZK rollups and optimistic rollups. And now what Vitalik does in this blog post, and it's a bit technical, but I think he does a really great job of explaining basically the differences between, I guess, rollups and state channels and plasma and sharding and all that. I'm not going to read the blog post, obviously, but you can see it's quite detailed here. He's got a really nice table here, actually, that shows the differences between optimistic rollups and ZK rollups, which I mentioned are going to be the two main ways that we scale on Ethereum layer 2. And then, yeah, it just goes on and on here about the computation, how it all works. I mean, as I said, this gets technical, but I think it's a pretty great overview in general if you want to get the gist of kind of where layer 2 is going, how it all works, why we've chosen rollups as kind of the vision here. So, and on that note as well, Eli Ben Sasson from Starkware, which is making ZK rollups, put together this nice little diagram here, which you can see. Maybe you can't see because my camera's blocking it off here, but you can see in the picture here. The bottom left is blocked off, but that's okay. Basically, he's comparing the different layer 2 scalability kind of technology, kind of the status of them. So ZK, he's obviously biased because Starkware is working on ZK rollup. So maybe take this with a little bit of a grain of salt, and don't take this as kind of like the kind of be all and end all of comparisons here. But basically what he's saying is that ZK rollups offer the best of both worlds. They offer the best in terms of like on-chain data and kind of off-chain data and security as well. You can see at the top there, he's got like a little meter that says, security is high for ZK rollups. Right now, that what's live is StarkX, which is the Diversify Exchange, Loopring, obviously, in ZK Sync. And then on testnet, you've got Aztec and Hermes. And optimistic rollups he's claiming to be a lot less secure and not on mainnet yet, but on testnets right now. And then there's a bunch of other things down the bottom. You can see Validium right there, which is also StarkX. And then on the right, there's Plasma, which is on Omise Go network. And then side chains on the far right there, which include Matic and XDAI. And obviously the security of them is quite low, simply because for those who don't know, the main difference is that a layer 2 inherits Ethereum security, whereas a sidechain relies on its own security. So if you're on an XDAI network, you actually aren't secured by the Ethereum network anymore. Your funds are now secured by the XDAI network. So it's not the Ethereum miners validating your transactions, it is the XDAI validators validating your transactions. And those validators are actually chosen by a part of something called proof of authority, which basically means they're handpicked by, I guess, the team in this case that built the network to validate the transactions. And if these people wanted to, they could basically censor your transactions or steal your funds in the worst case. So that's the main difference there. So whenever you hear someone talk about a side chain, just know that a side chain can be basically anything because it's not secured by Ethereum. Exchanges, like centralized exchanges, are considered side chains. Bringing your Ether over to basically anywhere that's not Ethereum and is not secured by Ethereum is a side chain, or any tokens or any kind of value that you're doing. So it's very important to remember that when you're seeing people talk about, scalability solutions and how great they are. You really do need to make sure that you know the trade-offs between them. And I hope it's not too technical, and that, the different projects actually kind of warn users and say, this is why you're secure here, in like language that they can understand. Because I definitely don't want to go down a path where the users feel like, they aren't secure, and then like we have like massive hacks happening because there's like $100 million on a side chain, and then someone's like, wow, I can just steal these funds, bring them back to Ethereum, and then no one can stop me. So yeah, we'll have to see how that plays out for sure. But I thought this was a neat little table. Again, though, Eli here is biased, of course, because he's working on ZK rollups. But we'll have to see what optimistic optimism and Fuel Labs and Off-Chain Labs comes out with as time goes on, and see if they kind of like have their own comparison here between the different rollup technologies. Finally, DC Investor put out a really interesting tweet today where he says that he bets that most people won't outperform just buying and holding the above assets through most of the bull market. And what he lists is basically 50% ETH, 30% DPI, which is the DeFi Pulse Index from Index Co-op, and 20% BTC. Now, I kind of agree with this to an extent, because I think if you look at the long-term trends here, and you're investing in other tokens over the long term, if you look at their price against USD, it can actually be misleading. Because if you look at it against USD, it can be going up, right? But then if you look at it against ETH and BTC, it can be going down, like down very quickly as well, because the USD prices of different assets go up with the rest of the market, right? Because the market caps of all assets kind of get re-rated. The entire industry every coin just basically floats up. Well, not every coin, but a lot of them, right? Whereas if you look at it against ETH and against BTC, it's much harder to outperform that because ETH and BTC are also going up. So this is why DC Investor says here that just split yourself, kind of like, you can split yourself evenly if you want, but he's saying go heavy ETH and DeFi, which I actually agree with. But basically, you split yourself between ETH, DPI, and BTC. You get exposure to ETH, obviously. You get exposure to all of DeFi, or at least the top DeFi apps in the DeFi Pulse Index, and you get exposure to BTC. These kind of things aren't going anywhere, right? ETH and BTC are here to stay. The DeFi Pulse Index tracks the top DeFi tokens, and they're here to stay. It doesn't contain all the smaller DeFi tokens, the much more speculative ones. It mainly contains things like Comp, MKR, LRC, SNX, RVER, all the top ones that the projects are actually kind of like, have a lot of traction here, and aren't very risky compared to the other ones. So yeah, I totally agree with DC here. I think that, and it's, I guess, like the portfolio also has things like YFI in it as well, so a bit more speculative, I guess, there. But yeah, maybe I should kind of like put together something for this and track it over time. During the kind of like from inception, the DPI only went live a couple months ago, or I guess 3 months ago at this stage. Kind of track the inception of DPI, and then from there as well, ETH and BTC, and track this portfolio over time, and then measure it against ETH and BTC, and then measure it against, like, if you were to go into individual tokens and hold them for the same amount of time to kind of see what happens here. It's going to be very interesting to see for sure. But yeah, I guess obviously not investment advice there, but something really, really cool to kind of consider there. If you're, more of a passive investor, you don't want to have to deal with the headaches of changing in and out of positions. And also, for those of us who live in kind of the Western nations, we have to pay like pretty high capital gains tax, especially on short-term trades. So that's another thing to take into account when structuring portfolios like this, for sure. All right, that's it for today, everyone. Thank you again for watching and listening. If you haven't subscribed to the YouTube channel yet, be sure to do so. Give the video a thumbs up, subscribe to the newsletter, join the Discord channel, and I'll catch you all tomorrow. Thanks, everyone.